Hello everyone, this is Professor Zhao at MTSU. In this last chapter in the first module, we are going to discuss capital asset pricing model and arbitrage pricing theory. Okay, as far as theory model goes, you might feel a little intimidated, but here I want you to know that no matter how complicated those terminologies are, we are simply dealing with risk-return trade-off. And the entire portfolio theory, which incorporates both capital asset pricing model, sometimes we call it as CAPM, and arbitrage pricing theory, or APT, are all used for us to assist our understanding of risk-return trade-off on the stock market. Now, let's start with this capital asset pricing model. And the capital asset pricing model essentially explores one critical issue. What determines a security's return? And the results of capital asset pricing model will show us that security required rate of return only have one factor, which is the systematic risk of that security, which can be measured by beta. And the capital asset pricing model, of course, is a pretty complicated model. It follows equilibrium analysis, and if you took any economic classes, you know that any economic equilibrium analysis start with assumptions. And this capital asset pricing model has a series of assumptions. Now let's take a look at those assumptions. The first assumption for the capital asset pricing model is that the markets are complete, equally profitable, or the market is a pure place, perfect place. And in this perfect place, no investor is wealthy enough to affect the stock prices, which means stock price cannot be monopolized by any individual investors. And the second, all informations are publicly available. And there's a zero cost acquiring those information. Third one is there's no taxes, no transaction costs. And the last one is there's unlimited lending and borrowing at a risk-free rate. And the second assumption is that investors have homogeneous expectations on both stock returns and standard deviations. Right? So that is the assumption, that investors tend to have same opinion in terms of future return and the riskiness of any individual securities. And investors are rational investors, and they are seeking best risk-return trade-off when they make portfolio choices. And typically on the market, if there is equilibrium in this perfect market, then the result would be that the security return will only related to its market risk, which can be measured by beta. And then there are two factors that will affect a typical security return. Of course, the first one is the market risk, or the beta, which measures the co-movement between individual securities and the market average. And another factor is called a market premium. And the market premium is also called risk premium on the market portfolio. The reason why market portfolio can generate risk premium is because when investor invested in the stock market, he or she will bear access risk. Right? And if investors do not want to bear any risk, then they can invest in risk-free assets. But if they want to bear more risk by investing in the stock market, they're supposed to be compensated by risk premium on the market portfolio, also called market premium. So what is a market portfolio? Well, market portfolio is a theoretical term. Refers to a portfolio that consists of all available securities in this investment universe. So it incorporates all risky assets, and we call that portfolio as market portfolio. And in reality, you just cannot find such portfolio. But in practice, professionals tend to use stock market index as a proxy for market portfolio. For example, S&P 500 index is a typical market portfolio proxy, but theoretically speaking, because market portfolio contains everything, all the risky assets in this universe, therefore it's really hard for anybody to find a perfect proxy for market portfolio. But in practice, people use stock market indexes as pretty good proxy for market portfolio. And once you found a risk premium from the market portfolio, then it's pretty easy for you to figure out what the expected rate of return that the security should earn. Well, that return has something to do with two things. First one is market premium, or risk premium on the market portfolio, and the second one is the market risk, which can be measured by the beta of that individual company. Now let's take a look at this picture, two-dimensional picture, which involves the relation between return and risk. And here the risk is measured by standard deviation. Right? And we have this blue line, blue curve, shows you the efficient frontier of the market portfolio. And here you have thousands, maybe tens of millions of risky assets. And when you combine those assets into your portfolio, and you know that the best risk-return trade-off can be achieved on this blue curve, and this so-called efficient frontier for the market portfolio. Right? And when investors need to make a decision on complete portfolio, they draw a capital asset allocation line. But once you draw a capital asset allocation line tangent to this market portfolio, we call it as capital market line. Right? And here we found this tangent point of M. This M shows efficient choice of the market portfolio. Right? And this market portfolio should earn expected rate of return on the market, and it should have standard deviation of the market. Now let's take a look at the capital asset pricing model. Previous picture is not a good picture for us to understand the essence of risk-return trade-off for the stock market, because it uses standard deviation as measure of risk. Right? So what's the drawbacks of using standard deviation as measure of risk? Well, standard deviation contains both market risk and firm-specific risk, which can be diversified away by building portfolio. So if investors are smart, then they should build portfolios to eliminate the firm-specific risk. The only risk that they need to deal with is market risk. Right? So our assumption is that the investors are equally smart, and they know the tricks of diversification. Therefore, all of them practice portfolio building, or putting many different securities in their portfolio. Therefore, only thing that they need to worry about is the market risk. So, in the context of portfolio, we need to change our measure of risk from standard deviation to beta, because beta only capture the market risk. So here is the capital asset pricing model. You don't need to worry about how complicated the equilibrium analysis is for this model. All you need to understand is the outcome of this model, which is expressed in this equation. And this ERD means expected rate of return for individual security. And the expected rate of return for security has two components. First one is risk-free rate of return. Risk-free rate of return. And the second one is the return that investor can earn by investing that risky security. Right? And here we have a product of beta of that individual security and the market premium, which is the difference between market return. This ERM is expected market return and risk-free rate of return. Right? So that is so-called market premium or risk premium for the market portfolio. That is the return that investors are supposed to get when they bear more risk by investing in the stock market. And for individual companies, for individual stocks, the return of these individual stocks should be determined by both this beta and this market premium. Of course, there's a third term here, which is the risk-free rate of return. And graphically, the capital asset pricing model can be expressed as a straight line in that risk-return two-dimensional picture, and we call this as security market line. Security market line. And the security market line represents expected rate of return and beta relationship that you can find in this capital asset pricing model. And individual asset return is a function of beta and market return. Let me show you the picture here. Security market line. Security market line. And here you have a market portfolio. And when you link this risk-free rate and this market portfolio point, you are drawing a straight line, this blue straight line. And you can extend this blue straight line indefinitely, and we call this line as security market line. And this security market line is in this two-dimensional structure. Two-dimensional structure. Return and market risk. Previously, two-dimensional pictures are pictures that show you the relationship between return and standard deviation, but here the risk measure has changed to beta. Right, why is that? Because here investors are smart. They build a portfolio so that firm-specific risks can be diversified away. Only thing that they need to worry about is the market risk, which can be captured by this beta. Right? And this security market line is simply the graphic representation of capital asset pricing model. Right. So what can we learn from this security market line? Well, first of all, if investor doesn't want to bear any market risk, then what should they do? Well, they should invest in risk-free assets where they can earn risk-free rate. Here, let's say 6%, and the beta is 0. Beta is 0. But if they wanted to improve return, let's say 14%, from 6% to 14%, and at 14% level of return, investors need to bear more risk in terms of beta. So they have to invest in stock market. They have to invest in stock market. And let's say they have something like a market portfolio. Then the beta should equal to 1. Right? And the return should be average stock market return, 14%. An investor can go further than that. They can choose security that is riskier than the market. Let's say a security has 1.2 beta, which means it's 20% more volatile than the average stock market. Therefore, return should be improved by this much. Let's say 1.6%. Right? And this is the risk reward to investor for bearing more risk by investing a riskier security than the market. Right? And any point lie on this security market line, any point on this security market line will show you an equilibrium balance between risk and return on the stock market. Well, your question is, what if you can find stocks that lies above this SMR line or below this SMR line? Well, in those cases, I would congratulate you guys because you are finding great investment opportunities. For example, let's say you found a stock that lying above this security market line, right? And this stock has beta risk of 1.2, and based on the current stock price, the expected rate of return is 17%. 17%. Right? But you know that for the stock that has beta of 1.2, it's supposed to earn 15.6%, but right now expected rate of return is 17%. So here you see a small gap here, 1.4%. What is that? That is so-called alpha. Alpha is a great thing for any investors. That is excess return that you can get from an imperfect market. Right? In imperfect market, stock prices may be misvalued, and in this case, this stock is overvalued or undervalued. You say if it's above, it should be overvalued, but actually it's the opposite. This stock is undervalued. It's undervalued. Because it's undervalued, that's why you can earn actual return in the future. Right? And when stock market moves forward, you know that mispricing can be corrected. Mispricing are corrected. This stock will fall onto this SML line to reach the equilibrium. In the short term, they might be mispriced, but in the longer term, market has self-correction mechanism, and that will push the risk-return trade-off of the stock back onto this SML line. Right. So expected rate of return will decline from 17 to 15.6%, which means stock price will increase. When stock price increase, this alpha or the excess return can be captured by the investor. Right? So for any point that lies above SML line, that represents investment opportunities. Investors should buy those securities. What if you find a security lies below this line? If that is the case, the alpha is negative. That means your excess return would be negative. And those are really bad investments because currently stocks are overvalued. You should avoid that kind of securities. If it's possible, you can do short sales to capture that negative alpha. So this SML line has great implication for any investors. Right? And investors can find valuable investment opportunities if they found any security lines either above or below this security market line, because those points represent the case where equilibrium of the stock market is violated. I mean, it's not always the case. In most cases, you wouldn't find such opportunity, but when the stock market goes through some volatilities, going through the chaotic situations, you could find this kind of opportunities. But in the longer term, the stock market has self-correction mechanism, and it will push those mispriced security towards this security market line. And the security market line shows you the equilibrium condition on the stock market. And the capital asset pricing model is a great financial theory and lays out the foundation for modern finance theory. And the theory was developed back to 1960s, late 1950s, early 1960s, and it become the Bible for the entire financial industry after 1960s. And all the financial managers, investors are using this model on a daily basis. First of all, they use this model to figure out if there's any investment opportunity on the market. And for corporations, managers are using this CAPM model to figure out the cost of capital, or cost of equity. And the cost of equity provides hurdle rates for internal investment projects. And the manager really want to find projects that can deliver internal rate of return that is higher than the cost of capital. So this SML line is very useful for any corporation to find cost of capital. And this cost of capital is equivalent to required rate of return for any securities, which we can find on this security market line or through this capital asset pricing model. So expect the rate of return for any stock or any corporation, or cost of capital for the company can be estimated by following this equation. And this equation have three variables. First one is risk-free rate, second one is beta, and the third one is market premium. Market premium, which is the difference between market return and risk-free rate. Okay, let's say you are CFO of a large U.S. corporations, and you wanted to utilize CAPM model to estimate cost of equity of your company. What should you do? Well, you can start with this equation, right? Cost of equity equivalent to required rate return for this stock, and it's function of risk-free rate, beta, and market premium. And typically you can get a pretty good number for risk-free rate. Risk-free rate can be found by looking at Treasury bills rate or 10-year T-note rate. And right now, the best proxy is 10-year T-note rate as proxy for risk-free rate on Wall Street. And the second variable is this beta. How do you get a beta? And the last one is this market premium. And typically people use something around 10% as expected market return. That tend to be the long-term stock market return. And take the difference between market return and the risk-free rate, you will easily get market premium. But how to get this beta? Well, here's how we can get this beta. We use index model. We use so-called single market index model to estimate the beta of individual companies. Right? So here is the regression that you can run. On the one hand, you collect data for individual companies' return over the last, let's say, 3 months, maybe 2 years, so on and so forth. And also you collect data for risk-free rate, as well as the market return. Market return can be found by looking at S&P 500 index return. Right? So you have 3 time series. Once you have 3 time series, you do a little calculation to find the excess return for individual security, which is the difference between security return and risk-free rate, and the market premium, the market return minus the risk-free rate. So you will have 2 time series, excess return of your security and market premium. Once you get those 2 series, you run regression. When you run regression, you will generate 2 very critical values. The first one is the intercept of the regression, which is alpha here, as well as correlation coefficient on this market premium variable, and we call this as beta. And also any regression will generate error terms. Right? And in this equation, you know that this beta captures the market risk, and this error term captures firm-specific risk. Right? And in a theoretical framework, you will see another expression of this index model. Let's show you that expect rate of return for your company at a certain time minus risk-free rate equals alpha. the intercept from that regression, plus beta, the coefficient estimation, times the market premium. Right? So that is a very typical way for any corporation manager to get beta estimation through regression. Right? Now let's take a look at one example. Let's say how we can estimate beta for a company called Google. And the first thing that you need to do is to get return data for 3 different securities. One is T-bills. The second one, of course, Google company, as well as S&P 500. S&P 500 is the proxy for market return. Right? And here you see average return, excess return, standard deviation, geometric mean, so on and so forth. Right? But essentially, you should have a spreadsheet that has the time series of the 3 variables. Let's say during the last 1 year, last 2 years on a daily basis or on a weekly basis. Then you do calculation to get excess return of Google as well as the market premium. Right, so instead of having 2 numbers, you will have 2 time series. And here you can visualize. You can visualize those 3 time series, T-bill, S&P 500, and Google. And they go up and down like crazy during the last 5 years or so, between year 2005, year 2010. And a typical regression will involve at least 1 year or 2 year data. And here's monthly data, and typically people do weekly data to improve the quality of their regression. And here's a monthly cumulative return for 3 different securities as well. And as I said, only thing that you need is 2 time series. One is the excess return on Google. The other one is S&P, the market premium, S&P 500 return minus risk-free rate. And once you get those time series, you can plot those points on this picture, right? And this 2-dimensional picture. And here is not a risk-return trade-off picture, but the return of Google, excess return of Google, and excess return of S&P 500. And you have many observations, right? And clusters like this, but you can run regression to get this regression line. This regression line will show you approximate relation between Google stock movement versus stock market movement. And here is the regression results you can get. R square. What is that? R square actually measures how good the regression is. 35% here typically means your regression is pretty good. Right? And it simply says the Google return can be explained by the market return in 35 out of 100 cases. So this is pretty reliable regression, and it simply says 35% of variation in Google return can be explained by S&P 500 market return. Right? So you have a lot of numbers here. Total number of observations, 60 months, that's 5 years, right? And you have degree of freedom, SSMS, F, and F here. You look at a p-value of the F and 0.00 mean, which means this regression is a pretty reliable regression. And you also have coefficient, intercept, SP 500, and standard error, t-statistics, p-value, so on and so forth. How do we find the useful information here? Well, our goal is to find the beta, or beta estimation through this regression. And it's here. The coefficient on this dependent variable, S&P 500, 1.2. That is the estimation of beta. Right? As far as estimation goes, it's not accurate number at all. It's not accurate number at all. And actually, you can look at t-statistics to see how reliable this number is. Right? And a low p-value and a high t-statistics means that this coefficient estimation is pretty good. It's pretty good. And with 95% of confidence level, you will find that okay, this beta coefficient range between 0.68 to 1.72. In the middle, that is 1.2, but there's a chance they can go lower or go higher. But 95% confidence level, at a 95% confidence level, it's very likely that beta estimation should be between those two numbers, 0.7 to 1.7. But in the middle, that's 1.2. That is a 1.2. Right? So that is how we get a beta estimation for a typical company. Once you get a beta, what will you do? Well, you follow this equation. All right? Expected rate of return of Google equals risk-free rate plus beta 1.2 times market premium. As I said, beta can be estimated based on historical data, but in the theoretical model, we are estimating future return of a company based on future beta. Right? So by using historical data, by doing regression, you can only get a so-called good estimation of beta. And actually, beta changes. Maybe during the last 3 months, beta was 1.2, but for the next 3 months, it can go up to 1.3 or go down to 0.5. Anything can happen. And through regression, we only get beta estimation. Right? It's better than simply take a guess. And if we believe that what happened in the past can continue in the future, then the regression can give you a pretty good estimation, but not a perfect estimation. Right? And empirical research found that, okay, beta changes. It goes up and it goes down, but during a long time period, beta has a mean reversion nature, which means it has tendency to move towards the average level over time. During the past, beta can be 1.2, 1.5, or as low as 0.8, 0.7, but you can look at, okay, the average level of beta during the past. And in the future, beta tend to move towards that average level. Right? So the regression will give you historical beta. And to predict the future beta, you wanted to do a little adjustment. Make sure that your future beta incorporate this mean reversion nature. So if your estimated beta is a 1.8, right, based on last 3 months data, then in the future you wanted to adjust that number down towards 1.0 because you know beta tend to move towards average level over time. And the CAPM model is truly the foundation for modern finance theory. It changed the way people understand the risk-return trade-off on the stock market. And the people use CAPM a lot, especially during 70s and 80s. But later on, the more people try to use CAPM in their financial practice, the more problem that they discovered. Right? So what a problem do they have? Well, here's a typical problem. Well, CAPM model says that required rate of return of stock only has something to do with market risk or that beta. Right? But in practice, people find that required rate of return has something to do with many other factors, not just beta. It may be related to, let's say, the interest rate change. It may be related to unemployment rate, GDP growth. Sometimes it has something to do with oil price. And also this required rate of return company can be related to the size of the corporation, the debt ratio of the corporation. But overall, people actually were losing confidence in this CAPM model, especially in 1980s and early 1990s, because They do a lot empirical studies, and they found that okay, in addition to beta, there are other factors working here, and the beta tend to have pretty weak explaining power for stock return. So where is the problem? I mean, this CAPM model is the foundation for modern finance theory, and all of a sudden, it doesn't work in this financial market. Why is that? Okay, now let's take a break, and we will continue our discussion on CAPM model and APT model in the second part of this video. Thank you.